Hi everyone, this is Luke from Stayden Financial Management. In this video today, we're going to be talking about topping up your UK national insurance contributions whilst abroad. We're going to start with an overview of the new UK state pension and how it is affected by the number of years of national insurance contributions that you've made. Then we're going to briefly discuss what the triple lock is and why it has such a positive impact on topping up your national insurance contributions. And then we're going to look at the different types of national insurance classes that there are and the costs involved. Then we're going to look at topping up. Who can top up? Can expats top up? And finally, we're going to run through some example scenarios, really there just to show you quite why this could really be the best investment you make in your lifetime. And then we'll finish with how to get started. So the new UK state pension was introduced in 2016. And the reason it was introduced was basically the old ways of calculating your pension were pretty numerous. There were lots of different state pensions. The second state pension, there was SERPs, and there was the basic state pension. And this situation led to the problem that a lot of people didn't really understand how much they were going to get at retirement. It was very complex for a lot of people to calculate, and it just caused a lot of confusion. So the Tory government in 2016 actually simplified the whole process by making the amount of state pension that you would be entitled to at retirement entirely dependent on the number of years of national insurance contributions that you've made. Now, the full UK state pension as of this date stands at £221.20 per week, or a total annual amount of £11,502.40. To get any at all, you need a minimum of 10 years worth of contributions, and it requires 35 years of national insurance contributions to get the full amount. Now, if you have more than a minimum 10 years, but less than the full 35 years, the proportion of the amount of state pension you get is in proportion to the number of years that you've contributed. So, for example, if you've contributed for 20 years, then you would be expecting to receive 20 divided by 35 times by the full state pension. And another way of looking at that is that for every year of national insurance contributions that you have, each year is worth an extra £328.64 per annum. So what is the triple lock and how does it affect your pension entitlement? Well, the triple lock was introduced as a way of stopping state pensions ever falling below inflation. Inflation is when everything gets more expensive on an annual basis. It happens most years, more or less, you can pretty much count on it. And because of that, this erodes the value of money. And therefore, if the triple lock, if the state pensions don't keep up with inflation, well, then in real terms of what you can buy with the state pension, that would mean pensioners would be losing out and having a lower quality of life year on year. So to stop this, the triple lock was introduced, and what this means is each year the government will look at three figures. They will look at the CPI, so the Consumer Prices Index, and this is pretty much a base measure of what we use to track inflation. They'll also look at the average workers' wage index, so the average increase in wages across the UK. And there's also a figure of 2.5%. So each year they'll take these three figures and they will just pick the one which is the highest. So the idea here is it's always going to match or beat inflation. And in practice, that is absolutely what's happened. If we look at what happened in 2023, the state pension increased by more than 10% because inflation was, I think, 10.4% that year in the UK. Inflation cooled off the next year in 2024, but because inflation was so high the last year, people who were working had less money, and therefore their wages had to be increased by around 8.5% that year, which also pushed up the state pension again. So the benefit of the triple lock is that your state pension is always going to outperform inflation, and sometimes quite dramatically. Now, there are 4 different types of national insurance contributions. There's Class 1, which, if you're watching this, you're probably the most familiar with. That is applicable to people who are employed in work. Class 2 is applicable to people who are self-employed working in the UK. And Class 3 is for voluntary top-ups whilst in the UK. And Class 4 is self-employed if you make a bunch of money. Now, funnily enough, expats can actually top up with Class 2 and Class 3 contributions. And the cost of topping up Class 2 and Class 3 contributions is based on previous year's costs. And currently, Class 2 costs £3.15 per week, and Class 3 is £15.85 per week. And the reason that it's so important to make a decision today is because when this was introduced, a lot of people didn't have as many national insurance contributions as perhaps they would like. And the way the government counteracted this was by saying, well, you have until April 5th, 2024 to fill up all of your missing contributions going back to 2006. Since then, they've extended that to April 5th, 2025. So you still have time, but as I'm filming this almost mid-March, not that much time. After this deadline, you can still top up missed national insurance contributions, but you can only go back 6 years. And also, just another note, if you're deciding whether to do it now or in a month's time, after this deadline, the cost of topping up your national insurance should increase too, as it tends to increase each year. So, topping up national insurance, UK residents can top up with Class 3, and the costs for top-ups are based on last year's tax rates, and it currently costs £15.85 per week, or £124.20 per annum to top up missed contributions. Can expats top up? Well, expats can top up if they've either lived in the UK for a continuous 3-year period or they've contributed 3 years' worth of national insurance contributions. But actually, expats might even get a better deal, because if you have lived in the UK for a continuous 3-year period or have paid 3 years national insurance contributions and were either self-employed or employed before leaving the UK and are currently self-employed or employed, well, then you can top up with Class 2 contributions. And the difference in how these interact with your pension, well, there isn't a difference. The only difference between the two is Class 2 are far cheaper than Class 3. As 1 year of national insurance contributions, remember, currently returns us an extra £328.64 every year in retirement, that means that if 1 year of Class 3 contributions costs £824.20, that means 2 years and 6 months into retirement, you'll have returned everything that you've put in to contributing to retirement to date. And as Class 2 contributions only cost £163.80, this will be repaid within 6 months of receiving your state pension. And that is assuming that they do not increase in line with the triple lock. So you can actually expect that this figure will be, well, you can expect the time it takes to repay how much it costs will actually be far lower. Or lower. I don't know about how much, about far lower. So when is topping up most effective? Well, the further from retirement you are means that the triple lock has more time to take into effect and propel your returns above inflation. If you have less than 10 years top-ups, then just getting to the 10-year period will be incredibly cost-effective in terms of return from investment. And of course, if you qualify for paying Class 2, so you were employed before you left the UK or self-employed and currently employed or self-employed, which applies to a lot of expats, that is the most effective way of topping up. So the other thing to understand, though, is that normally when we look at investment returns, high investment returns require high investment risk. But NI top-ups are very secure, low-risk investments, but as I'm hopefully going to show you soon, they actually have very high returns. And they provide income security, predictable returns in retirement. And not only is that great from a terms of financial security perspective, it also is just something less to worry about. You know, when it comes to money, I think most people don't want to become incredibly rich. I mean, it'd be nice, But what we really want is to not have to worry about money and having a secure income which is going to grow by inflation each year. Even if it doesn't cover everything that we want, but it covers some, that's just one less thing to worry about. But before we look at when topping up's most effective, let's have a quick look at when topping up is the least effective. So if you're very close to retirement, there's no time for the triple lock to really scale up the value of your pension. If you've got to pay class 3, those are of course the most expensive contributions. And if you've contributed more than 10 years worth of national insurance, you're above the minimum requirements, and therefore it's slightly less effective than if you have less than 10 years. And to illustrate this, I'm going to use an example scenario of Bethany. Now, Bethany has spent 29 years contributing to national insurance while she was in the UK. She then left the UK and has around 8 years of national insurance contributions she is eligible to top up. She's planning on retiring next year, but because she's currently unemployed, she can only pay class 3 contributions. Now, although she has 8 years that she can top up, she's only going to top up 6 because it doesn't make sense to top up any additional contributions, which will take you past that 35-year max, full state pension requirement. If you have 37 years, it's not going to get you any more money than having 35 years. So she should save her investment and just top up the remaining 6. Now, the total cost for this will be £4,945.20, £824.20 times by 5. And what this does is that it increases the yearly income from £9,768 to £11,789 in the first year. But that is still going to increase every year due to the triple lock. And in less than 3 years, Bethany will have received more money than she put in at the start of this investment. And the remainder of her retirement just has very predictable, recurring profit. After 10 years, the total profit from this investment is £17,698, which is a return on investment of 316%. After 20 years, which is essentially the average life expectancy that we can expect to achieve after retiring or after reaching state retirement age, the total profit or the expected profit from this would be £46,684, which is a return on investment of 944%. And we can see here that the break-even point is 2 years and 146 days. That is the break-even point from putting how long it takes her to get her initial investment back. And I think that looking at these stats, topping up Bethany's investment with class 3 contributions should be considered a good investment. And the investment returns 944% profit after 20 years, which is an annualized return of 13.7%. Now, to put this in perspective, if we look at the S&P 500, which is a high-risk investment, but it tracks the 500 largest companies that you can invest in America, and is a go-to for many people when it comes to investing, that long-term return on investment is 10%. So this is beating out one of the world's favorite long-term high-risk investments. And the flip side of that is that while it has very high investment-like returns, from a risk perspective, remember, normally we have a risk versus return perspective. In order to get these high returns, we've got to increase our investment risk, but not in this case, because this risk is akin to lending money to the government. It's akin to a UK government bond, which is one of the lowest risk investments you can make, because essentially what you're doing is you're giving the UK money and it's agreeing to pay it back to you in the future. So this is a really good investment. But if we compare it to other returns that expats can get from investing in national insurance, it's actually probably the least effective or least generous example of topping up your national insurance contributions. Because let's just have another look at Bethany, and now imagine that we've got the exact same scenario, but she's got 10 years until retirement rather than just one. Well, it will cost her £4,945.20 again. And let's just go to the interesting stats. After 10 years, this leads to a £23,333 profit, which is a return on investment of 472%. But after 20 years, which is the average life expectancy that we're kind of benchmarking in retirement, that's a profit of £59,332. Remember, of an initial investment of £4,945.20, which is a return on investment of 1,204%. That is more than 12 times what she put in profit. So she'll return in total about 13 times what she put in after 20 years. And in this circumstance, the break-even point, so the time it takes her to receive all of the money that she put in, is below 2 years into retirement. And again, this still looks like a great investment. And it looks like that because it is a great investment. But let's now assume that Bethany was employed before leaving the UK and is currently employed in the Netherlands. Now, she can pay Class 2 contributions rather than Class 3. So the cost to top up has now shrunk massively down to £982.80. And after 10 years, the total profit on that is going to be £27,295, which is return on investment of 2,777%. That's 10 years, 20 years, which is our benchmark expected life expectancy. The total profit is £59,033, but the return on investment here is 6,460%. If you are wondering whether this beats stock markets in general, it definitely beats pretty much every stock market that you can think of. It beats quite a lot of crypto too, to be honest. And the break-even point, the time it takes her to repay her investment that she made into topping up her national insurance contributions, goes down to 142 days. So less than a year, or less than half a year into her retirement, she's got back everything that she's put in, and then she's got another 19 and a half years of pure predictable profit, which is tied to inflation. But let's see if we can make it even better. So let's have a look at our example scenario of Timothy. Now, Timothy worked in the UK for 9 years between 1996 to 2005. So he has the full 18 years at his disposal, so 2006 to 2024, that he can top up. Because he only worked for 9 years, he's only got 9 years of national insurance contributions. So currently he gets no pension. He gets nothing in retirement. And if he doesn't make contributions, that will continue. Immediately before he left the UK, and he's currently employed in Europe. Now, because he's eligible to pay Class 2, the total cost to top up 17 years of contributions is going to be £2,784.60. Now, if we assume the lowest possible growth rate of 2.5%, after 22 years, the state pension will have risen by 72%. In all of these examples, I've been assuming the lowest rate of growth possible from the triple lock. In practice, these figures are actually going to be a lot larger and more generous. This will return profit above £10,000 for Timothy in year 1. So in the first year, he's going to get over £10,000 back from an investing £2,745. Did I get that right? No, £2,784. But nevertheless, it's a crazy return on investment. A 10-year return on that investment is a profit of £168,000, which is return on investment of over 6,000%. The 20-year return on investment is £387,000, which again is a return on investment of 13,913%. So that's over 139 times what he put in is his expected return. And it will take him 66 days into retirement. So 2 months and a week into his retirement, he'll get everything back he puts in today. And then he has the best part of 20 years of pure profit. I mean, the key points here is that topping up your UK state pension provides a massive amount of extra security in retirement. And as an expat, you'll either be eligible to pay Class 2 or Class 3 contributions. And both of those contributions are worthwhile. Class 2 are so worthwhile, though, they do make Class 3 look bad. And I have been a victim of this, where I have, essentially dismissed Class 3 as being a good investment just because Class 2 exists. But if Class 2 didn't exist, I'd be making this video nonetheless and telling you they're probably the best investment you could make this year. Class 2, I would say, is probably the best investment you can make in your lifetime. It is an incredibly low-risk investment, very predictable. It is backed by the UK government, and it's going to beat inflation over the long term. And the returns on investment for making it are also incredibly high and beat pretty much every stock market in existence. So it's almost a no-brainer for an investment for expats. Now, how to get started? Well, the process as described online is you log into your national insurance record and then they ask you to call the Future Pension Centre. That is a trap because they won't answer. Some people I've spoken to have said they got through, but I've called them for hours on end and never got through. And all they're going to do is tell you, well, yeah, you can qualify somehow, fill out a CF83 form, send it to the HMRC, and they will send you a form back saying whether you can contribute and what the costs are. Sending the CF83 form, if you're worried about, if you don't want to pay Class 3 and you only want to pay Class 2, you send the CF83 form, it doesn't commit you to anything. It just gives you an answer on if you can top up and how much you should. So, for example, I have my answer here, and my answer basically dictates the years in which I was outside the UK, I can pay Class 2, and the years in which I was in the UK, I can top up with Class 3. The problem is that as I'm currently filming this, if I take the amount of time it took for my application to be received, looked over, and then sent back to me, anyone who makes that today is out of time. And this is largely because there's been a huge amount of people in the UK who can only top up Class 3 who are applying to top up Class 3, and it's kind of overwhelmed their resources. So that's the bad news. The good news, though, is that there is a request for a callback form. And the request for a callback is pretty simple. You just put in your mobile number, make sure you put your country code if you're outside the UK, and your full name. But the reason you want to do that is because requesting a callback entitles you to be able to top up your national insurance contributions as if it was before the deadline, if essentially the time gets pushed over the deadline. Because they don't have enough people to speak to everyone, they don't have enough people to advise everyone, but they do realize that the majority of people do need advising on this. So if you use the request for a callback link and submit your details, then you should be able to top up past the deadline. What I would suggest, though, is when you make that request for a callback, screenshot everything. Screenshot each time you press a button on the page, so that if you miss the deadline, which we're most likely to do at this point, you can say, well, this says that I should be able to pay afterwards because I did request a callback. Expats have been able to contribute Class 2 contributions since 2016. I remember when I first saw it, I thought this won't last a year, they'll get rid of it because it's such a good deal. There's no way they're going to keep this, but they have. And the only answer I have as to why that this is still here really comes down to just government oversight. They haven't really thought it through. They haven't kind of done the maths. And I would top up as quickly as possible because this may not stay around forever. In the description of this video, I will include links to all of the relevant government websites. So I'll include the link to request a callback, a link to look at your national insurance record, a link to the CF83 form application process. I've been Luke Saden. Thank you for watching. If I can leave you with one thought, is do your national insurance contributions. Almost definitely worthwhile.